And you like there's something really interesting there because it's like doubling down on stocks where the valuation is cratering. If you've done the work and you have a good rationale for that, that can be like an incredibly powerful tool. But if you double down on a losing stock just because the value's gone down and you haven't done the homework, like often that's an easy trap to fall
Yeah,
into, and
it's
often
a
that's a
falling
mistake.
knife. Yeah.
Exactly, exactly. But and the nuance is like your rationale. So maybe coming out of stocks and talking about like your methodology and your thinking, like that's a common one, doubling down on your losers. And, really we want to be adding to our winners. But as a dividend growth investor, are there particular mistakes or value traps that say a lesser experienced dividend growth investor might be prone to?
Yeah, and I think they're similar to the growth investing style as well. So, for instance, simply not understanding the business that you're investing in, and buying stocks because you see them mentioned on social media, not knowing how to read the three financial statements. You must, of course, specifically to dividend investing. I'm particularly saying not growth in this is yield chasing. Yield chasing. I think we've all been victim to that. Actually, sometimes I even do it still, but that's more influenced by the high income factory, the income factory book. So yeah, but still, I tend to look at dividend safety there. So yield chasing for me is that you go for 7+% dividend stocks there, and there, for instance, a really nice picture from AG Bell. I think is that a bank in the UK? AG
Yeah,
Bell.
like a broker. Yeah.
Yeah, exactly. I will share the report with you. But for instance, they say many dividend yields compare well to gilts. Yeah, and they show a picture of 10 stocks there from the UK. Only four out of them didn't have a dividend cut in the last decade. Yeah, but these are all high yields. So legal and general 8.6% yield, but never a dividend cut in the last decade. Then you have Phoenix Group, 8.5%, but it cut the dividend twice. So yield chasing is a very clear one that I think many starters in the dividend investment community get there, because one of, if you have a strong desire to become financially independent, then yeah, my portfolio yield is 3.8%. I could stop working today if I start buying high yielders tomorrow, and my portfolio would yield 5 or 6%. I can stop working, but I don't like the risk element of that, and yield chasing is one of those parts of that. But for the rest, it's just like value traps. Yeah, I think that's a big one.
Edgy, could I ask you to sort of let me try to translate that into maybe like a moral of the story. On the growth side of things, when I say if something is too good to be true, it probably is. I've learned from experience that that's not the case because uh, when you get companies that are 10x or 100x from, and you start on the journey early, you kind of have to have this almost optimistic, overly optimistic vision of what could be. Whether they make it or not, that's life, and there's lots of things that that's not a good moral. But on the is am I hearing you correctly that when an investor who's new to the dividend style investing, if they simply look at the highest number, highest dividend yield, that if it's too good to be true, it probably is? Is that
Yeah.
a reasonable
Yeah,
sort of
yeah, yeah,
mantra
yeah. I
to?
would say anything nearing a 10% yield, you need to do so much due diligence. Because let's face it, what are we talking about when we say 10% yield? Then we are saying that the multiple of the company, if you inverse it, can't be more than 10 times the profit. Yeah, the market cap to profit cannot be more than 10 times, because, and then because it inversely, you get then a 10%, let's say, dividend yield. And I guess I'm talking more about shareholder yield, which probably suggests that they are paying out more than they are earning. Yeah, so you really want to stay away from those companies. Those are very red flags. It can, that's why I mentioned just before with Shell cyclical stock. They will look totally different at the bottom of a cycle. That looks like it's horrible to invest in. Yeah, but in the top of the cycle, they look undervalued. But generally speaking, yeah, you're right. When it's a 10% yield, all your alarm bells should be ringing, and you should really understand what the hell is going on there.